Hey, what's going on YouTube? In this video, we're going to go over Cisco Systems, ticker symbol CSCO. They reported their Q1 24 earnings November 15th, beat top and bottom lines, but they did not give us the greatest of guidance. And with that guidance, all analysts had revised their expectations lower on this company, which we go over shortly. Year to date, the company is basically flat, and over the course of 1 year, also relatively flat. So in their earnings call, what they guided for the fiscal year of 24 is between 53.8 and $55 billion in revenue. We come over here to the valuation spreadsheet. 2022, we did about 51.5 billion, and last year we did about $57 billion. So we're looking to come within between 2022 and 2023 levels. Not the bad, not the worst thing in the world. Obviously, every company sees a reduction in revenues eventually, and this is the time for this company right now. And the reason for the reduction in their overall revenues is because they believe the primary reason is that customers are currently focused on installing and implementing products in their environments following exceptionally strong product delivery over the past 3 quarters. So basically, customers that have purchased in the last 3 quarters are now trying to play catch up with the products that they ordered from Cisco. So they are estimating that there are about 1 to 2 quarters of shipped product orders still waiting to be implemented by its customers. It's forecasting some pretty, not super substantial, but definitely declining revs for the next, for at least the next couple quarters, potentially for the rest of the year. And with that, analysts had revised their expectations lower, and that is the big hit to the overall stock price currently. Back to a financial spreadsheet, and we're going to look at our charts here, go over our charts and see how this company is performing. And revenue, gross profit, net income growing, but not at a crazy rate. It is just, obviously it just looks like it's just very slowly just kind of growing, making a little bit more money each and every year. We can see our net income is on an upward trajectory. Hopefully it continues that way for many years to come. Gross margin last quarter 65.2, trailing 12 months 63.7. So margins are still starting to creep up a little bit higher yet, so that's good. Net margins 24.8% last quarter, and trailing 12 months 23.4. Same thing. We're starting to see record net margins, at least what we can see in the last 10 years here, 8 years. Revenue, gross profit, year-over-year change. Did see a little bit of some growth last year, but we are expecting to see a chart like this for the next quarter or for the next section of trailing 12 months. Return on invested capital, very healthy at 23.4%. We have a PE today at 14.45. Earnings yield 6.4%. Cash to debt, we will take a peek at that on their most recent earnings report, and we'll go over the cash to debt because it is a lot better than what we're seeing right there. Net income to free cash flow, we do produce more free cash flow than net income. We've done that every single time, and we can see, we come over here, here's our free cash flow. Free cash flow continues to grow, $17.6 billion in the trailing 12 months, and only a capital expenditure cost of $673 million, so pretty good. Share count dilution, they do have a share buyback program going on right now. We can see we are getting reduced in share count, which is always good. Dividends, continuing to pay out dividends and consistently. So over to the balance sheet. We've got $23.6 billion in cash. We add our cash equivalents plus their investments that they've got. And then we come down here to our liabilities. Total liabilities is $53.5 billion, but I personally like to strip out deferred revs on long-term and short-term. That total amount is $25.6 billion in deferred revs. So I deduct that from $53.5 billion of liabilities, which leaves us with $28 billion in total debt. And they've got about $23.6 billion in cash. So not quite a net cash positive company, but not too far from it. And they are positive free cash flows. So if something was to happen, their free cash flows would likely cover their difference in their cash to debt ratio. But down here on our cash flows from operations, we have $3.6 billion in net income. They did have a big hit to income taxes. That could just have been timing. That's usually the case. And then we have a total cash from operations of $2.3 billion. We have CapEx of $134 million for a free cash flow amount of $2.2 billion, and that is in the last 3 months. So very good. Also worth noting, their repurchase program that they've got going on, they have bought back 23 million shares on an average price of $54.53, and they've got $9.7 billion left in their repurchase program. Also, they have acquired quite a bit of companies in the last quarter. They've acquired 5 different companies, and they are still working on acquiring Splunk, which is supposed to close in third calendar of 24. So hopefully this year sometime. Now, one negative to all these acquisitions that this company is currently making is what Peter Lynch always says, is that this could be diversification because they are just acquiring company after company after company, but this might just be throwing money down the drain, and not really providing any true value to the company. So something to potentially dig deeper into, look into some of these companies and see if they're actually making decent acquisitions or not. Over to the comps, I put in two other companies to compare to. We come down here to our comparison charts. We can see market cap to revenue on Cisco is crushing the other two competitors. And we come over here, our growth rate, we are seeing pretty substantial growth in the competitors. Cisco still showing a little bit of growth. Obviously not next year, but this is over the course of the next 5 years. Gross margin on Cisco, we have seen a little bit of an uptick in gross margins overall. Obviously, we can do a little bit better if we can catch up to this company, but overall margins historically have been very consistent at about the lower 60% range. Come over to your other two margins, operating and profit margins, obviously doing very good compared to the competitors. Free cash flow, doing very good. Return on invested capital, very solid. Current PE, 14.4. And that tells us we're cheaper than the competition right now as well. Earnings yield, 6.4%. So overall, when I look at this, I am very comfortable continuing to analyze Cisco because it does have pretty good margins and everything else on the board looks pretty decent for this company. I wouldn't just ignore the other two companies. I'd probably look into FFIV a little bit deeper potentially, but obviously we can see how relatively new this company is and maybe it's got plenty of room to grow. Over here too, our calculator on appearance valuation gives them a price tag of $27.37. Multiples comparison is $95.38. Our manual PE, we take our market cap minus cash, add in debt divided by cash from operations. It'll take about 18 years to earn our current market cap. Price to book, 5-year average, 4.9. Price to book today, 4.3. Graham's valuation gives them $64.83 per share. Dividend discount model, $50.52. Over to our free cash flow. Analysts have a growth rate of 10%. Historically have done 7%. I gave them 8%. I'm not anticipating too much free cash flow growth rate, especially for the next year, but we'll obviously wait and see. But that gives them a DCF price per share of $90. Rule 72, we have three sources of an EPS growth rate. With those three sources, we get an average of 7%. That goes into 72 10 times. That goes into 10 years 1 time, so we get to double our current EPS 1 time to 6.62. On to our summary. Cisco currently trading $47.92. Our fair market value that we just got over all our calculators is $58.62. 30% margin safety, $41. Analysts have a price target of $57.82. So we're about right in line with where analysts are on this company. Now, I think it is worth noting that we should probably adjust our EPS because they are forward guiding between like 297 to 308 for next year's full EPS. So I think what we should do is reduce our current EPS to 3, go through all of our calculators again, and make sure that we are valuing this company to the end of next year's earnings per share estimate. So we make those changes real quick. That gives us a fair market value of just $55.32. So didn't really change our fair market value all that much. We did just reduce our EPS by 31 cents. We've maintained our growth rates though across the board. So going forward, we might see a bit of a, maybe a potential 8% growth rate on our EPS. But this is probably a better valuation right now, because we know that they're forecasting about $3 per share of EPS, and this is probably a more fair market value for the next 12 months. And obviously beyond that, we could see some growth coming back into the company. But over to the stock chart in this company. So we've got this long-term trend line, upward trend line, and I think we're going to come back into this trend line right around the $44 price point. We got a little bit of some support in this range here, about $44. And then we've also got this long-term upward trend line that goes all the way back to 2016. You could probably draw it back a little bit further if you wanted. So I think we're pulling back into this range, maybe not immediately, but over the course of maybe a couple months, maybe a week or two, we might pull back into here and then might chop around right here for a little bit and then maybe start resuming higher. But that all will come with earnings and see if forecasting doesn't change within this company. But that is it for Cisco Systems. If you found value in this video, drop a like, subscribe, and comment. We'll be back later to another stock analysis video.